let me throw this back to Andy. I'm sure Andy's always monitors questions while I'm teaching, and I'm sure with this many people on the call today, we probably have some great questions. Andy.
Yeah, we do. We have some questions. I had a couple of questions too, but at the beginning, when you were talking about the possibility of tax change as soon as 2021, after the November 2020 election, I'm wondering if the Senate, if let's say Trump does lose, and the Senate doesn't turn over.
Game over. Everything stands still.
Okay, but does that mean does the likelihood of a tax increase rise in 2021 if that happens?
I don't think so. I think the Senate would not allow that to happen.
So the possibility of a tax increase really rides on what happens with the Senate.
That's right.
Yeah.
Well, I mean, you're assuming the president loses. Nobody knows what's going to happen with
Oh, of course. Right now the polls are, that's what they're saying. So that's why I'm just trying to focus on that issue. Also, when you referenced Judge Ginsburg, is there a tax angle to it, or because I was surprised that you brought that up? And
no.
Okay.
No, here's the important part. The Senate cannot get to secure. They're saying they don't have enough time. And if you want to see a very large use of the Senate's time, it would be going through a confirmation hearing. Because look at what happened with Justice Kagan. Look at what happened with Justice Gorsuch. Kagan was more brutal than Gorsuch, but you can see we'll have a period of time where the Senate is devoting their energies to vetting the next Supreme Court justice. That's my only comment. There's really not a tax angle to that. It's more of like they're not going to be able to get stuff done. So we know in January, it's already been referred pretty much, we're going to have an impeachment hearing, which is going to take some time, right? And the issue, the way I understand it, is that all the senators have to sit as a jury. So if you're in this hearing, you can't get anything else done. And I suspect there won't be. I've done a lot of expert witness work. Most people aren't going to have a lot of energy after listening to that level of detail all day long to do other things. They're just going to be getting ready for the next day.
That's really amazing. Because you were at, some months back, really sure that Secure Act was going to get done.
Yes, I'm embarrassed. I mean, called it totally wrong.
Well, we don't know that yet, but your humility is appreciated. I have been sending you over those questions. We've got a lot of them. Do you want to just go through them? Because you usually zip through them then.
Okay, actually, I don't see anything in my email from you yet.
Oh, I'm sorry. I thought I not an email, but I can put them in an email.
No, that's okay.
I've just been assigning.
Are they in the question pane or?
Yeah, I've just been assigning them to you. But let me be prepared.
Let me try to open that up, Andy. Maybe just read a couple while I'm trying to open this up.
Well, give me 1 second. I'm just going to email it to you so that I get that out of the way, and then I'll read one.
Oh, okay. I have it open, Andy.
Oh, well, I'll email them to you, but go ahead.
Okay, Jason writes, Biden also wants to tax capital gains as ordinary income. So There we go. Jeff says, don't we need one common law employee beyond a spouse to get ERISA protection? Yes, I thought I said that, but if I didn't articulate that right. So if it's just husband and wife, you're not going to get the ERISA protection you want. You're stuck with state law. But if it's husband and wife plus one other worker, then you're going to get the ERISA protection you want. Okay. Kathleen writes, can the owner of an IRA have CRT be the beneficiary of the RMD and take the income from the CRT? No, but you can have your IRA paid to a CRT when you die. Are short-term losses against long-term gains still an issue in the lower tax brackets? Probably not as much, Peter. I mean, because if you're all at the zero rate, it doesn't much matter. When you're planning years beyond.
What do you mean still an issue?
Oh, what Peter was talking about, my little chart with the 4 boxes of efficient, inefficient, that little box on the capital gain harvesting. Peter points out that if you're in the, if you're making 30 grand, it's not going to much matter because you're all in a 0% rate anyway. When you're planning for years beyond 2025, do you assume continuing current tax rates and law, or do you assume we'll sunset? Oh, I would assume we sunset.
Great question. We'll read the question again slowly, but so
okay.
That everybody understands.
When you're planning for years beyond 2025, do you assume continuing current rates, or do you assume a sunset? I would assume a sunset. I just don't see any way that we end up with something other than the sunset. Because this, the situation, the tension between both political parties has been high for so long. I just don't see any magic that's going to happen to fix that.
Yeah, Sam Fawaz, thank you for that question, Sam Fawaz. And it's
now Jeff writes.
Fawaz is probably it. I'm sorry.
Jeff writes, can you have a chance to talk a little bit about QBI and how that may play into Roth conversion, and how about the Roth conversion amount may increase the QBI deduction? Okay, Jeff goes right to the deep end of the pool. Okay, here's the deal. Let's say your business income, so you're a barber, your business income is 100 grand, but your taxable income, because you took a 24,000 standard deduction, is only $76,000. Your 199 cap A deduction is limited to 20% of 76,000 because it's the lesser of your business income or your other income, your actual taxable income. If you did a $24,000 Roth conversion, now your other income and your taxable income and your business income are pari passu. They're the same. And now you get an additional $4,800 of the 199 cap A deduction. In other words, the essence is, if you're in that situation, Jeff, your tax on your Roth conversion is reduced by 20%. Very, very good question. Okay, we only have a couple more. Peter writes, otherwise, the $3,000 annual loss you can take against ordinary income has low future benefits. Sure, that's absolutely right. I mean, if you're in the 10 or 12% bracket, that $3,000 loss doesn't mean much. But 12% of $3,000 is $360 you didn't have. And more importantly, maybe you can get somebody to clean up some of their portfolio, because clients we all like to live in this fantasy world that it's not a real loss till you take it. So, Andy, we've covered a lot of ground. We've actually gone over. It's always an honor to be here with A for A. Back to you.
You got a couple of more there. I just forwarded over. And then Nick is asking, God, I don't know why I must be doing something wrong. The slides are available because everybody asks this every session, and I cover it at the beginning of every session. So Slides are available at advisorproducts.com. And you could just chat us and we'll send you the link. Ben, if you could chat out that link right now, that would be great. But they're $50 a month for the whole year. You sign up and you get this whole database of all of Bob's presentations, and we transcribe them. So that's how you do that, Nick. Thank you for that question. And Bob, what do you see that? I think you got another question from Jason.
Okay, now Jason always asks the best questions. Should give him like a little medal or something, Andy.
That is Jason Hogstad, by the way, who does ask questions.
With respect to the Opportunity Zone funds, have you seen any offering liquidity to investors prior to year 10? Not really. And yeah, if everybody wants to sell, does that drive the price down? You're going to have restrictions. These agreements seem to have restrictions on how much you can sell, because clearly all of us can't go through, we all can't bail at the same time. And aren't the odds of capital gains being higher in 2026 great compared to now? Yeah. If let's say you had a $1 million gain, if you just sold now, the worst the tax would be $238,000. Okay, I think that's right, 23.8, forgetting the state. So it's $238,000. But in the future, even though let me just do the math, even though you'd only pay tax on 85% of your gain, if you take 238 divided by 850, if we go up to a 28% rate, you're in the same place, and this is interesting, and you've maybe just wasted all that time in that investment, and you would have been better just to do something boring like buy a spider and not worry about it. Now, the one thing about Opportunity Zone is everybody's forgetting. Let's say I invest the $1 million in year 1, and I eventually have to pay tax on $800 on the $1 million gain, minus the 15% basis I'm allowed. So I eventually have to pay tax $850. But let's say that $1 million investment 15 years from now has grown to, it's growing by 7% a year. So it would have gone to, maybe it goes to $2.5 million in round numbers. The gain from $1 million to $2.5 million under the law is tax-free. So what everybody's missing, everybody gets all excited about the deferral and the 15% basis. That's the bright, shiny object. What you should be focused on is that all the post-investment, the true gain on the investment, not the original gain you rolled in there, but the true gain under the statute is absolutely tax-free. So, Jason, kind of think about that a little bit too, because I think that's what, especially me. I mean, I've been focused for months on the bright, shiny object, and then I suddenly started really looking at this when I laid it out in an Excel spreadsheet for someone, and I kind of had a epiphany of what was really important here. Okay.
Yeah, Jason, thank you for that question again. I think, and you see his response there in question, right, Bob?
Right. I mean, his last question is, why don't, the Opportunity Zone developers are going to add the value right away. They might want to bail out. I'm not so, I think the contracts will generally prevent them from bailing, but when we read these contracts, that'd be an important thing to look at. But if you're going to put people in these sponsored Opportunity Zones, just really be careful that the company you're dealing with is solid, and that it's just not, a den of evil MBAs who expect to all make $3 million a year for doing very little. Because that's my greatest fear on these things, is that all the people that work for the sponsors are extremely well educated and probably earning very good salaries. And, you know, really how much of the return are all those salaries going to absorb? So I'm probably not a very nice thing to say politically, but that's what people like you guys and ladies have to be fearful of is who's really getting the return on my client's money, the sponsor or my client?
Great point. That's really wonderful because this area is attracting problems. And I think that it's up to, you know, the kind of professionals that attend these sessions to really kick the tires on these and watch out for package deals and sharks. And that's the history of this kind of stuff. This always happens every time, right, Bob? Don't you think? Like whenever one of these tax deals comes along, there are always these characters that, you know, that now you're saying they're sharp-elbowed MBAs, but who knows? But there's so much, you know, so many greedy people out there, and this is a popular marketing idea. So I think your advice to really check the fundamentals is right on. And I am happy, and I think, you know, I don't know if but I think I've got to find somebody that's really kicking the tires on these things and who has a good handle on the big picture on this. So and they're out there. So I will do that. We're going to have, you know, I've got a new speaker coming on compliance who's really great for RIAs. And I'm working on some other speakers, and this is, you know, opportunity zones is definitely in you know, in my sights because it's such an interesting area. It has so much potential. So thank you for that, Jason and Bob. So everybody, we went through pretty much all the questions. I don't think I missed any, but wow, cool. We really got deep into it. So thank you, everybody. Thank you, Bob. Great stuff. We'll see you the 10th at Fritz's next session. Thank you again, everybody, for attending. Thank you, Bob Keebler. See you guys later.